Hello, hope everyone is doing well. So, excuse me one second. There we go. So let's see here, where to begin? Well, if we look back, you can see that we have been in a bear channel, and just like the prior opens, yesterday in particular, we tried to break below and failed. Here we tried to break below, so there was a possibility of a measuring gap down. That's what the bears ultimately wanted, but they failed. And as you can see, daily chart, August, here's the August sell-off. We tried to break below yesterday's low, and we obviously failed. Weekly chart, close somewhere in the middle. So, you know, there's something interesting going on, and that is, notice the past 3 days. A lot of times, there's a lot of similarities. You know, for example, we've had an early high of the day the past 3 days in a row. It might do that. There's usually patterns consecutively in the days, and what I mean by that is you can get, you know, a day where you get a, let me find a good example. It's not really what I'm looking for. Yeah, I guess this kind of works. You know, you can get a lot of days where you get some sort of trading range behavior where you test up for 6 or 7 bars, and you test down, and you test down for 6 or 7 bars, and you test up. You know, you kind of look right here and see. Basically, the market tried to have the open be in the middle of the day's range, which we tested up and tried to burst down. And, you know, there can be a lot of, I guess what I'm getting at is similarity with consecutive days in a row, such as you might get a trend from the open, you know, maybe a bull trend from the open many times in a month, and then not see any for months. You know, there's usually pairs. They usually happen. For example, usually you get there's a, you know, the saying, bar one's usually the first. Bar one has a 20% chance of being the higher low of the day. Well, there are days you can get that 3 times in a row and then not get any for 2.5 weeks. So just kind of interesting to note. You got trend down, spike down, but every one of them failed. So if you see it, this is a bear channel. So I guess it is possible that we break below the bear channel, but, you know, just like here, we reversed strongly. So traders thought, gee, if we do this here, we'll probably reverse strongly. So coming into today, we were probably always in long from this, I would say. However, you know, how strong is your conviction? Gee, I don't really know. I think always in long, bar 1 and 2. However, here's what you have to know. Look at bar 1. The high was 94 even. Bar 2, the high was 96.25. Now, why is that? Well, that is 4 even to 6.25 is exactly 9 ticks. That means a lot of traders either sold the bar 1 high and 2 points higher, or they simply sold 2 points higher, which price went 1 more tick higher to let them in, and they scalped out somewhere over here. So ask yourself on the open, not a strong trend bar, more of a trading range bar, and bears are able to make money. That doesn't happen in a trading range. Plus, look where we're opening. You have to thinking maybe we'll get some sort of measure move down, but probably won't. We're probably, yes, this is strong, and it's a spike. It is a trend. In no way do I think you should be buying when you see this. You should be selling. And the reason for that is, pick any bar. You could sell here. If you put a stop up here, you made money. So first off, I'll discuss the always in direction for always in trading just real quick. Just get that over with. So for always in today, you short below bar 3. If you don't, maybe here. Definitely this bar. You've had a breakout and follow through. So stop up here though. I can see the reasoning behind getting out here. You've had a decent profit. We broke below yesterday's low, but did not really get a good follow through bar. So plus the past other days we have pulled back, as you can see here, and we did on the other day. So I can see the reasoning for getting out. I can see the reasoning of getting out here as well. It's a second entry buy for the failed breakout of yesterday's low here. And if you don't get long there, I think you have to get out of shorts here, I'll put it that way. If you don't get long, maybe you buy this close or this close, breakout, follow through. But you have to be aware of one thing, and that is, if this is a trading range, which it's probably going to be more of a trading range than a trend, and the reason why is think about the math. I hope I made this clear in the last video, but I want to just restate it. Your risk is your risk. It doesn't matter. You sell here, your stop's up here. You sell here, stop's up here or here. And if you shorted here and now you're here, your stop's here. So it doesn't matter where you enter the trade. It matters where your stop is. Traders who sell a full position here, once they get to here, they have to take profits. They have to take something off because their risk will be too big. Same thing, that's why traders who sell here, when they put their stop up here or here, have to trade smaller. So, it's kind of the, okay, let's put it this way. Let's say you shorted here, and by here, you put your stop at break even up here. And you let price stop you out here, and you gave up, we'll just say 10 points to keep it an easy number. Now let's say someone else sold here and put their stop right here at the break-even point for the bears, and they lose 10 points. Well, you can make the argument that the first trader, so if you shorted below this bar, trader A and then trader B sold here, and they both got stopped out at quote-unquote break-even, except trader B obviously lost 10 points. Even though trader A, you can say quote-unquote broke even and didn't make anything or lose anything, that is not really the case. You have to remember, your unrealized profit is your profit. As if you sell here and price is down here, you've got over 4 points in your bank. And if you let it come against you, that's your fault. It's not anyone else's money. As soon as that one tick of profit goes in your account, it's your money. So when you sell here and you're down here, or price is down here, you're now risking this many points or this many points of risk. Open profit really, to me, doesn't exist. Of course it exists, but and I can, here's where I'm getting at. It's one thing to sell here, take half off down here, or take 75% off somewhere, and then move the 25% break even just in case we get a trend down. That is completely understandable. Many traders do that. For instance, a trader that bought here, took half off here, and moved the rest to break even, they did well. But if you don't take any off and then lose it all again, well, you lost 10 points. You didn't make 10 points, you lost it because you had it in your bank. Anyways, traders short here, they get out. for sure here, maybe they go long here. Here, I think they need to get out, especially here. And the reason is simple. You have sell the closed bears and buy the closed bulls. Trading range day. And believe it or not, traders are willing. Look at this. Traders are going to short this close, and they're going to sell above this high because they know even if price goes all the way up to 50%, they'll just sell more. So think about this. And this isn't a coincidence. If I sell here, put my stop up here, and let's say I could trade small enough to where my risk would be the same on any trade, and I could allow myself to scale in. Well, if I scale in over here, the math's pretty good that we'll test down. And you can see we tried here. We let this bar, let bears who sold this high out. This let the bulls who bought this close out. So, think about it. Trading range day, whenever there's a logical sell or logical buy, we usually have to test down to it because not everyone's going to give up. You can say, yeah, bears are giving up here, but not every bear. There are strong bears. You know, it's kind of well, I'll just leave it with that. So up here, what you need to be thinking, gee, we might test down to here. It might, yes, you can make the argument it's always in long. However, some traders say it came always in short on this bar, so until we get above this price, it's going to remain always in long. Excuse me, it's going to remain always in short. So until price breaks above here, it may remain always in short the whole day. Some traders will think that. Most traders, I believe, will say, since it's always in short still at this bar, we may test down to this close. Therefore, bulls who are buying up here, they think, hey, it could possibly test down here. I'll put a stop down here, and I'll add on more lower. Same thing with here. You know, if you remember, Al said during the webinar, I can't remember where it was, but it was somewhere in here. Somewhere from here to here, he stated that he thinks price will test back up to here. And the reason, and someone at the end of the day asked if it was because of buy the closed bulls, and he said yes, and of course it was. You have bears who sold here. They think price will test back down to here to let the scaling bears out. Bulls will buy this close, stop somewhere down here, and they'll buy more lower, maybe above this bar, maybe above here, maybe on a limit order somewhere down here. They know the odds are extremely high, price will test back to here. It's the same thing as, well, look right here. Yeah, it's the same thing as this. I pointed this out the other day. You sell here. Some traders will say, gee, it's always in short, because they'll say here, if I sell here, put my stop somewhere up here, and I scale in here, that's interesting, isn't it? Just to show you what, how much of a quote-unquote coincidence these two stop entries are. You have to always respect scaling traders because they really will win 90% of the time if they're good. Look at these two examples. This is what I'm talking about, how the market kind of repeats itself. It does similar things. If you think about it, why does the market cycle, how does it change? For instance, how does the market cycle go from trending behavior to trading range and then stay in a trading range for a long time, then to turn into a trend? Yes, the market's always trying to find equilibrium, but you ever noticed how for a while sometimes the market will be great for scalping, terrible for swinging, and then for a while it'll be great for swinging and harder for scalping? Well, that is because, think about, the market's dominated by institutions, and institutions have algorithms. And to keep it simple, they have a lot of algorithms. A lot. Not 5 or 6. I'm talking about, they use, hundreds of them and throw them away. And, they're paying mathematicians, and I'm pretty sure this is true, they're paying them upwards of $300,000 to sit there and write codes for a long, long time. And Al even said in the webinar one time, I don't remember where he went. So I think he went to like University of Chicago or something like that. But point being, he said he wanted to at first be go into study mathematics. Now, I can't really honestly think of forgive me if any of y'all are mathematicians, I can't think of the proper name for it right now, and I apologize. But, and he even said for someone who has a degree in, math or equations, all that stuff, one of the top paying jobs is Wall Street, because they will pay you to sit in a cubicle and write equations and solve probabilities. So anyways, notice here, start with this one. Here's the stop. Here's a low 2. You had a low 1 and a low 2. So it's logical to short there. Now, let's say you're a trader and you say, okay, I'm going to sell here, but I'm going to trade half. I just kind of want to, there we go, I'm going to start with here. It's easier to say. I'm going to sell here, I'm going to put my stop up here. But I'm going to allow myself to be able to scale in somewhere up here in this area, somewhere here, and keep the stop up here, and not risk more than I'm used to. So let's say if you trade 100 contracts total, they may trade 25 and 25, something small. They'll trade small where it's comfortable. It's interesting. Here's half of a measured move. So basically, they sell here. Here's their risk. It's up to the high of this bar. Here's halfway. Why do we have a stop entry halfway up compared to here? Well, if it's always in short, based upon this leg, and this may just be a bear flag and a pullback to the upper third of this trading range, quote unquote, we may test down all the way to here. So what do you do with that information? Well, you need to be thinking when you see this, we may test up pretty far. However, we could test down. We may test down to here, somewhere. This is a pretty tight channel. It's been going on for about 2 hours from here to here. However, don't be fooled. So what do you do with that information? Maybe if you see this forming and you say, that was a decent low too. If I was an institution, I may short this low too, put a stop up here, and I'll sell somewhere down here. And gee, what do you know? Maybe it looks like we're getting a decent signal bar out here. So maybe what's the odds if I short here and I sell more here? What's the odds that we'll get back to here? Well, I think it's 60%. And I think it's 60% because a lot of traders did that. And I might take a half off and I might bet on a new low of the day. So it's interesting to notice that stuff. And I think it's no surprise that we test it down. There's so much information on the chart. And for anybody that tells you it's noise or it's just a lot of BS, I mean, they're ignorant. I mean, man, you don't know what you don't know. There's so much information on the chart. And the reason for that is, well, there's so much. Another trader might say, let me just kind of think of some things. I'll give you another side of that. Here's a possible measuring gap. This low to here. Maybe a trader will short here saying, gee, we'll probably what are the odds that if I short here, put a stop up here, which surprising, not really, just really kidding, it's not a surprise. If I short here, bet that we close the gap before we go up here, What are the odds of that? Well, probably 60%. It's all about an equal distance move. It's the same thing I said yesterday about if you say, gee, here's a spike. If I buy somewhere down here, what are the odds if I use a stop this far? It's the distance from here to here. If I buy here, excuse me, what are the odds I can get to here before it stops me out down here? Well, probably 60%. It's really a math game. It's really all it is. You know, another trader will say, gee, you know, maybe these were good by the closed bars. You know, this was a strong bar. I'm going to buy here. I'm going to keep my stop down here. So where it clearly became always in long. And I will add on somewhere lower. And they got out. So back to this. You know, take this example. This low 2. Here's your stop. Here's halfway. Gee, here to sell the closed bar. I might sell this close. And I'm going to say, let's say this. I'm going to sell this close. And I'm going to sell more halfway up. Because arguably, this was the spike from this low to here. So I'm going to sell halfway up. And hopefully on a stop entry. And I'll put my stop up here. So I sell this close, sell more up here. And look what happened. So even though, in conclusion to that, although you may think this is really strong, well, it's a second leg trap. And it's really, I don't really consider it a second leg. Yeah, it is. You can say, here was the first leg, here's the pullback, here's the second leg. So it's technically low 2, which it is. But more importantly, just it's a trap. It's a vacuum. Think about the channel. You know, if I do this right here, my computer will cooperate. What do you see? Well, I go like this. What do you see about this? I see a high, a lower high, lower low, lower low, lower low, a lower high, a lower low, a lower high, lower highs, lower lows. I see a lower high. So, you know, Al talks about this in the webinar as well. Let's say you don't have the time to dedicate to trading a 5-minute chart, or maybe you just don't like trading a 5-minute chart. Maybe it's too many decisions. Well, here's the channel. We'll spike down. I'll sell bull rallies in the upper third of the range, and this is what's going to be interesting. Here's a leg. This is kind of how scalpers would trade in a way. Look, upper third. Ignore this blue line. I'm going to do this a couple times, but just ignore. Oh, here. There we go. Sorry, I'm taking a. I just want to kind of show a point. So here. There's a leg down. Came to the upper third. Here's a leg down. Came close to the upper third, but not quite. Doesn't have to get there. Here's a leg down. Came halfway. You know, point being, find the prior leg. Here's upper third, prior leg, middle upper third, prior leg, kind of the upper third. Let's say maybe, you know, here's the prior leg. It's around the upper third. Bears will short strong closes. That's all I'm getting at. Strong close, sell. Strong close, sell. Strong close, sell this. Bulls will say, yeah, it's strong, but I think we'll test back to these closes at some point. So anyways, the reason why it's reversing so much on a day like today is because sell the closed bears, buy the closed bulls. Sell, they'll stop up here. They know the odds are so high, price screen testing on here. So take that trader who says, gee, I gotta get rid of that blue 50% thing will kill me if I don't get rid of it. There we go. So anyways, trader might say, gee, you know. So back to the question. How do I, as an individual trader who doesn't want to scale in, use this information? Well, here's a leg down. It's pretty strong. It's probably not all that likely to reverse up. It's probably, and if you've been in the room or you've studied out, you've heard him say it, it's probably going to have to test down and form a bottom, such as a major trend reversal. You ever thought about what is major trend reversal? What is it? Why does the market usually have to form a double bottom or a double top before it reverses? You've heard, if you've been in the room and out of the room for any length of time, studied any of his work, you've probably heard him say that a lot about double tops and bottoms. Well, I've concluded, it's really nothing simple. I just kind of what I believe, and I'm pretty sure it's kind of what Al is implying. What does double bottom mean? So right, for instance here, why is it that this is lower probability to buy than this second entry buy? Second entry buys are a double bottom. Why is it? Think about it for a minute. And obviously, it's a second entry buy, so it's the second chance, so therefore it's higher probability. Correct. Of course you're correct. But there's another reason, and this is kind of the more foundational reason. This is a line chart, as all of you know. So now, I'll raise the question again. Why is this? Here's what I'm getting at. Traders will sell closes on a line chart. Computers will. They will sell, and they will sell every pullback. So they'll sell, just kind of for illustration purposes, use this. They'll sell, scan in, and they will exit break even. So they will sell the whole way down. Al said it himself. If he was going to create an algorithm, he would create an algorithm that sell closes, sell and scalp, sell and scalp, sell and scalp, sell and scalp, sell, trapped. And then he'd scale in and he'd try to get out break even. Look right here. This is basically break even. If you sold here, sold this, sold more higher, got out break even. Scalpers, and especially extreme scalpers, they're selling, and they're going to sell every close until they get quote unquote trapped where they have to scale in. They'll sell this close, scalp out. They'll sell this close, maybe this high, and they will scale in higher. That is why this bar tested down to here, reversed up, and then we tested down again, and we went below it. It let out scale in bears. That is why the double bottom, what it does. That's what a major trend reversal does. There are some traders who say, I'm going to hold short until the market proves to me, and I'm going to trade small enough, so they'll hold and they'll take some off. They're going to wait for the market to prove that the bulls are strong. So, for instance, they're going to wait and they'll say, gee, this is pretty strong. Okay, I'm going to sell here, and I'm going to try and get out break even. And then they're going to step aside because they realized that buying down here was too low. Find another example. Well, I want to find like a real clear one, something that's just yeah, I like this one. Trading range day. This is the Fed day. Big, huge reversal down bar, but there was no follow through, and it paused at the 60-minute chart. So normally you might be thinking, gee, we may go down for a measured move. Well, since there wasn't follow through, we may not. But it's probably strong enough for a second leg. Here was a second leg now. Sell this close. They scalped out. They'll sell that close. Scalped out. They'll even sell this close. Maybe they scalped out. Maybe they didn't. They'll sell this close. They'll sell this high. So let's pretend you sold this close. And you said, okay, I'm going to put my stop somewhere over here. I'm going to sell this high. So I'll sell here, and I will sell more right here. Kind of interesting. So, sell this close, 3 bars up. You're saying, gee, that's kind of disappointing. maybe I should try and sell this high, and I'll sell the high of this bar that I entered on, or that's my signal bar, if you will. And I'm going to try and get out break even on my original and with profit on my second. So I'll sell here, and I'll make money on my second, break even on my first, because this is probably strong enough close that we'll have to test down to it. In worst case, I can try to get out break even on the entire trade. Well, look what happened. You ever heard Al say, you know, this may be good enough for a scalp, but we may have to test down? He said it here. He said it's probably good enough. It's good enough for a quick scalp, but I wouldn't swing it because we'll probably have to test down and form a better bottom. Well, look at this. Why did we go? Just for I'll show you. This close was 58.25. This low was 58 even. Why did we go one tick below the close and then immediately reverse up all the way? Do you think it's just because sheer coincidence? Or could it be because it's sell the close bears who scaled in and said, okay, that's a disappointing enough pullback. This is probably a trading range. I'm going to scalp out. Well, let's look over here. Buy the close bulls. They bought more lower, scalped out. And yes, it's the weekend or it's the next day. I understand that, but it's the same point. So that is why double bottom works, because traders want to be proven wrong. They'll sell, they'll scale in, and they will scalp out. So over here, you will have bulls who say, gee, it's always in long. This is a pretty strong reversal up. Even if we sell off, I'm going to buy this close, and even if we sell off, I'll just buy more lower. Well, maybe for some, stop goes here. Buy that close, put a stop down here, and I'm going to look at scaling lower. Well, here's a decent low, here's a decent high too. Maybe I'll buy above that bar. Some traders are going to say, yeah, it's disappointing enough, I'll just get out on the entire trade. And Al showed this in his webinar. There's the break-even point. Other traders will say, gee, you know, stops down here. I'll buy above this bar, and I'll take profits here. Maybe I'll take profits back at the open of the day, the high bar 1, the close of bar 2. Here's the close of bar 2, 93.75. Oh, and by the way, if any of y'all have TradeStation, if y'all know this blue little data window, every time I move it, it shows price and the volume and the time. If y'all know how to change the color of that, would y'all please let me know? I'd love that. I don't need it changed, but you know, it's kind of neat. So let me know if you have TradeStation. You know, please comment. Anyways, look at this close. Because my problem is sometimes the black bar is a bear bar, obviously, and sometimes when I'm it's hard to see the numbers. Anyways, the close of this bar was 93.75, and the high of this bar was 93.75. What a coincidence. Huh. So let's think about this. Here's the high close of the day. We touched the high close of the day. We went one tick above the high close of the day. I wonder why that is. Well, some bulls will buy and they will use an absurd stop, and they will just buy more lower and say trading range we're probably going to get back to this close either some point today or tomorrow or Friday or Monday. Other traders will just say, you know, here's a decent major trend reversal. We broke up, tested down. I'm going to buy here. And gee, I don't know. Maybe I'll put my stop down here. I'll buy right here, which interestingly enough, why is it this goes so back to over here? I'm just having trouble finding it. Here's 50%. And I know I keep just saying this more than I probably should, but I will. I'll point it out. Here's 50%. Traders sell here, scaling higher around 50%. Traders sold this close, scaled in higher around 50%. And now isn't that interesting? If this was the stop, This was a little lower than 50%. However, if this was the stop, the low of the day, at 50%, right on the money. Why would that be? Probably because scaling bulls say, gee, I'll buy here and I'm going to look scale somewhere around 50%. If you're aware of it, you may think, let's say you did buy this. You say, that's an interesting high too. Here's a reasonable close. If I was a bull, maybe I bought that close and put a stop down here, and I'm looking to scale in. So what are the odds that, what's the odds price will get back to the close before it comes down here and stops me out? Well, I think it's pretty close to 60%. Now here's the key. Here's kind of the trading range. Market's always trying to trap you out. It goes below one support but not the next. If you put your stop down here, you've been stopped out. You're kind of upset. Hopefully you got back long if you did. Now some traders may say, I'm going to initially, I'll take half off here, and then I'll go for twice my actual risk. So at some point, look at that tail. I bought here and then price. I did not, but I don't honestly remember what I did. I think I was honestly just long. Well, didn't really matter. I think I got out. I bought up here, got out here, and then I think I bought here and pretty much held. Got out over here. Point being. Anyways, back to what I was saying. Say you bought here and you say, gee, price is going my way. I'll take half off here. Maybe I'll go for twice my actual risk. Wonder why it's that bar. So guys, this is why price reverses so abruptly. Look at this close. Strong. Probably this is a reasonable place to buy. If I put the stop down here, scale in here, got out break even. Break even on the first, profit on the second. Now look at this right here. I'm going to buy this close, stop down here, maybe down here. And I'm going to say, gee, you know what? Here's a great place to buy. And maybe, so maybe I buy here, and I hold and get out break even. That's why we have that tail right there. Or maybe I say, I really don't like that. We may get a second leg down. Maybe we'll test. You get a leg one, pull back leg two to the open of the week. I should probably just get out break even. Look at that tail. Look at here. Here's a good high one buy. I'll buy above it and I'll scale in more down here. Got out break even. And last but not least on this, look at that. We had one here, sell is closed, sell, I'm getting dizzy, sell here, scale in more here, stop up here, sell this close, scale in 50%, stop down here, buy this close, scale in right here, stop down here, buy this close. Gee, I wonder why that's 50%. Why do we have a great bull bar right at the 50% level? That's interesting, isn't it? Guys, it's no coincidence. I know I'm being kind of sarcastic, but just trying to drill a point in it. I know if you're swinging on a day like today, I completely understand it. I still catch myself thinking that's this sometimes, and that is. I'm not perfect. I still screw up plenty of times. Yeah, you sell here and you get a windfall profit, then you hold and you think, oh my gosh, you've lost all your profit. You think that's so, it's so unfair. You buy here, stop down here, and it comes all the way down here, almost stopping you out and saying it's just completely unfair. And it's hard, but you have to understand. If you can understand what's going on, you'll do a lot better. Like for instance here, tested the open of the day, tested the August high sell-off, You have sell the closed bulls who scaled in, stop up here, who bought back down here. That's why we had to test down there. You buy the closed bulls who bought here. They scaled in somewhere down here, and they're looking to get out. So think about it. When you see this, and you see a sharp sell-off, you have to be thinking, if we test down, there's probably going to be a lot of bears who are going to be very thankful to get out and very happy to get out and take the profit. If we test back up here, we may find profit takers who are very happy to get out. If we test up here, we may find profit takers. If we test this low, we may find profit takers. We'll test this close probably. That's why abrupt reversals happen. Traders know if they sell somewhere in the middle and scale in. So if they sell somewhere up here in the middle of this leg from here to here, scale in, and then they'll sell more here, they'll get out with the profit if they sell anywhere. So you can still swing this, but it makes it easier to understand what is going on in the big picture. Great day for scalpers. You can sell every close, scale in, get out. So let's take the always in perspective now that we kind of have an understanding. Okay. First stop entry, it's always in long, but you hadn't had a good breakout or good follow through or good stop entry buy, so just barely always in long. Decent signal bar. I'd rather wait. The signal bar is bigger than I really want it to be. Maybe sell here. Definitely sell here. Stop up here. Good. You've got a failed breakout yesterday's low, and you've got a second entry failed breakout yesterday's low. I think always in bulls have to get out here perfectly. I have no problem if you buy here or wait to buy here or here. And if you get this bar, you've really got to be thinking how strong of a bar. Just because we reversed up from it doesn't mean these were strong. I mean, look at the contracts. This is let's look at this. 50,000 contracts, 40-something thousand contracts. These are strong. So we'll probably test down. You got to look at these. Traders are buying. That's why the bar looks this size. So yeah, I think you get long. I think it's nothing wrong with getting short here. It's a low 2. You might still be always in short because of this move. We may get a second leg down. Get out here. If you don't, you get out here. Here's a buy. Here's a high 2 buy from this leg. We're in the bottom of this range. We tested here. I would get out of shorts. I'd definitely consider going long. Stop down here. Double top, really hard to get out. You're forming a triangle. So I didn't mean to do that. There we go. Just for illustration purpose. I'm not going to actually delete the lines. Forming some sort of a triangle. So anyways, not enough to make you go always in short. A classic example. We fell below support, but not here. And this was probably the stop for the bulls. So it's arguably just a two-legged pullback. But bear sold this close, scaled in, scalped out. There you have it. Here's a second entry buy. If you're short, if you're not long, I would get long. I think you're still long from this. Maybe if you got it up here, get long again. And you stay long. Here's a breakout. I mean, I see nothing wrong with getting up below this bar. It's at the open of the day. We kind of, here we go. Always look, and I just now noticed this, kind of wish I would have noticed earlier. Always be on the lookout for deep, reasonable signal bars. The ones that look good in the context isn't terrible. Here, you could have argued a bear channel. This is an endless pullback when they get a breakout below the low of the day. Reasonable place to sell. Traders will put a stop up here and they'll scale in. So let's look at this again. Not really that great of one. So anyway, not really finding what I want. Anyways, so we may test down, and that's exactly what we did here. So traders will sell here. They'll say, gee, I'll sell this close. We've had 3 bars down. I'll get out here. So anyways, you're long through this. If you don't get out below here, I think you have to get out on this close or below this bar right there. Stay short here. I think you go long. We tested support this low part. We stayed above here, so we may test up. Yeah, I'd at least get out of shorts. If you don't, I think you have to get out of shorts on the third, fourth bar. Probably go long, and you stay long basically to the end of the day. So, I hope all this makes sense. Trading range day, you've got to look for everything that doesn't seem likely is possible. Everything high probability is not as high probability as you think. Here's the high of the day. Here is the low of the day. Just kind of point out something. Here is the upper range, this blue line. Here's the lower range. We spend a lot of time here and a fair amount of time here. Trading range behavior. So I hope this helps. If there's anything I could do better on these videos or anything you'd like to know more of or just ask a question on, please let me know. Thank you.